Joining us now is Cantor Fitzgerald, head of derivatives and cross asset, Eric Johnston. Eric, good to see you. So, you've been bearish for a while, and I know it's a new year, but how does that pan out now? You think you should be short, low-quality, small cap. You don't think the growth trade is going to work for too much longer, but I guess you can't look at Bitcoin because it's tended to be good for that low-quality stuff, and it's been higher.
Yeah, thanks for having me. So we think that that the mega cap outperformance that we saw for most of 23 is going to resume itself, and it's going to come. We think that ultimately low quality, small cap, cyclical is going to underperform, and we think that trend is going to persist until we see a economic downturn. But until then, we like the Mag 5. We're not a fan of Apple and Tesla, as our clients know, but we do like the Mag 5, and we do like other large cap, high quality names. We think this is an environment where they'll do very well. And if you look at there was a lot of excitement came about at the end of last year around small cap and cyclicals, and we didn't buy it. We thought it was very much a trading year-end phenomenon. But when you look at the fundamentals of small caps, their earnings estimates have been declining. They had negative year-over-year growth. They're most hurt by higher interest rates. They're most hurt by credit contraction. So this is not an environment that is favorable for that group. And yes, they've underperformed a lot over the last year, but that's not a reason for that to change. And so we think this trend is going to continue that we saw in 23.
And you think long end bond yields have just about found a floor here. What does that mean for what you do with fixed income versus equities, and at what duration?
So we think that fixed income looks far more attractive on a risk-reward basis than equities. Our view is that when I say that bond yields have found a floor, I think that until the market sees the economy really weakening, if you look at the 10-year yield example, we think it's going to find a floor in that 385, 390 area with risk to the upside. And essentially, the thought process is we still have a Fed funds rate that's more than 125 basis points above where the 10-year yield is trading. And so the 10-year yield is pricing in a significant amount of cuts when you consider the term premium that's also in those types of yields. But the reality is that I think over the coming couple months, we are going to find, I think, stability in the bond market. And a lot of the big moves that we've seen over the last 6 months, when we've gone from 3.5% to 5% back to 4%, I think those are probably in the short term probably behind us, and is going to be much less volatile going forward. But there's a lot of places to be within credit, both private credit, within high yield, that we think offer very good returns relative to what you can get in the equity markets.
Yeah, financials is one of the worst performing sectors today. Banks really taking it on the chin in terms of trading losses today. Concern about the bank earnings, which begin to kick off with some of the biggest banks tomorrow. How are you thinking not only about that sector, about how it is gearing us up in general for this earnings season, and for Wall Street estimates that some would debate are perhaps still too lofty as we look to 2024?
Yeah, so I think that this quarter's numbers are going to be fine. I think the outlooks are where they're going to disappoint investors. So, regional banks certainly, took part of that year-end rally of buying sort of smaller cap, beaten down, underperforming names. They got this big ramp into year-end. Well, now it comes down to the fundamentals, and I think that when they report and people go through the numbers, I think the quarter, like I said, will be fine, but I think there will be continued concerns for the overall regional banks. And yes, the 2-year yield has come down. Yes, there are expectations for rate cuts, but that's going to take time to impact the regional banks. And then, of course, you still have this looming issue out there around credit quality. And so right now, credit quality is essentially fine, but that's a looming concern that is not going to really go away. So that's going to be sort of an overhang for the group. So we do think that group probably will be under pressure, despite the fact that this quarter's numbers are probably going to be fine.